This is UK national debt since 1780. It tells part of the nation's story. Napoleon's defeat at Waterloo didn't just change European history, it saved Britain from bankruptcy. The two world wars once again saw debt surge, as the debt provided an emergency, a lifeline for a country at war. However, despite no global war, debt is once again rising to record peacetime levels, and it's forecast to keep rising over the next few decades. And it's not just the UK, you can see a similar trajectory with the United States. Who is buying all this debt? Will the UK go bust? And who benefits from all this debt? Well, when the government spends more than they receive in tax revenue, they make up the shortfall by selling government bonds. These are typically bought by private investors, pension funds, investment banks and wealthy individuals. If you have a pension, you will probably indirectly have a stake in a few government bonds. But mostly it will be the richer investors who have significant spare savings. In the UK and the US, around 30% of government bonds are held by overseas investors. In recent years, government bonds have also been bought by central banks through a policy known as quantitative easing. More on this later, but this shows who owns the UK government bonds at the end of 2023. It's also interesting to see how this has evolved in the past 20 years. Back in 2003, when debt levels were much lower, insurance and pension funds owned nearly 70% of all UK bonds, overseas investors just 18%, and the Bank of England nothing. So we've become more reliant on the Bank of England asset purchase facility and overseas investors. But interestingly, the Bank of England is now reversing quantitative easing. It's selling those bonds it bought back onto the gilt market. So the government not only has to sell all the bonds to fund its current borrowing, but also the Bank of England is selling additional bonds. With gilts maturing, the Debt Management Office will be selling 296 billion of government gilts in the financial year 2024 to 25. What if people stop buying? I mean, that may well sound like a lot of gilt sales, and a good question to ask is, what happens if the private sector and foreign investors don't want to keep buying UK gilts anymore? Well, firstly, the government will have to offer a sufficiently high interest to attract the private sector to buy bonds rather than, say, invest in the stock market. When inflation and interest rates go up, this causes higher bond yields to keep investors buying UK bonds. And of course, in recent years, the cost of debt interest has increased quite substantially. UK debt interest payments have doubled since 2021 due to the higher inflation and rise in interest rates. It means that debt interest payments are now one of the biggest components of UK government spending. And this is one of the big costs of government debt. It is £120 billion going to these pension funds and investment trusts that can't be spent on healthcare or lower taxes. It's a similar story in the United States, where growing budget deficits are increasing the debt interest cost. The US debt interest bill could reach $1.8 trillion in 10 years' time. That is, some people receiving an awful lot of interest payments. Now, it is worth pointing out the private sector do have a lot of savings. UK households have a total of $2 trillion in cash savings. UK pension funds assets of $3 trillion. There's an estimated 21 to 32 trillion pounds in offshore bank accounts. In 2024, the global asset management industry had 128 trillion of funds to invest. The point is, there is a lot of global savings which can be used to buy bonds if investors think they are relatively the best option. Of course, amongst the very rich, there's a lot of tax avoidance. They tend to have lower rates of tax because they gain income from capital gains and things like that. So it does mean that they have a lot of money to buy the bonds and, of course, get the interest payments. Now, who benefits from the debt? Well, in a national emergency, government borrowing provides an emergency escape valve. So in COVID, the deficit rose to 15% of GDP, but this borrowing helped to provide furlough payments to workers who weren't able to go to work. It kept the economy going, and it provided a boom to healthcare spending, which was needed at the time. Another good time to borrow is in a recession, because in a recession, spending falls, people tend to save more, interest rates tend to go down. Now, if the government tried to balance a budget, they would need higher taxes and or lower spending, but that would make the recession deeper. What the government really should do in a deep recession is to actually borrow more, increase investment and stimulate economic growth. Because once the economy is growing, it becomes actually easier to pay back the debt you've just taken on. The big reduction in debt in the post-war period, where debt fell from 250% of GDP to around 40%, was not due to continual austerity, but from a long period of economic growth. In fact, the reduction in debt occurred despite setting up a welfare state and the NHS. However, if the economy is growing relatively well, interest rates are high, inflation is picking up, then increasing borrowing will have many drawbacks. To give one example, the United States at the moment is proposing to offer big tax cuts, mostly for high earners, and they're going to fund this by increasing the deficit. So richer households will benefit from tax cuts, which will give them more savings. So in theory, they can then buy more US bonds. The government then pay an interest on the bond they've just bought. So you could say that the net effect is rather similar. Those richer households are funding government spending by buying bonds rather than paying taxes. But if you had levied taxes instead, the government would save all those debt interest payments. Now, it is worth pointing out, John Maynard Keynes advocated government borrowing in the Great Depression because unemployment was so high, and he said you shouldn't leave it like this, you should do something about it. But at the same time, he also advocated reducing the budget deficit during a period of economic growth. The problem is that when the economy stagnates like the UK in recent years, it becomes very hard to reduce the deficit at all, especially when you've got all these spending commitments like more pension spending going up. What can cause debt default? If you look at countries who have defaulted on their debt, usually there is some serious structural failing with the economy. Venezuela defaulted on debt in 2017 after a fall in oil prices caused GDP to collapse and the currency to fall, but there's also an undercurrent of corruption and printing money which caused inflation. Argentina have defaulted several times this century, usually after printing money and high rates of inflation caused a big fall in the value of the currency, making it then hard to repay debt denominated in the dollar. If we look at these different levels of government debt, there's a huge variance between Denmark at 30% of GDP and Japan at 250% of GDP. In fact, Japanese debt is a little misleading. Its gross debt is really high, but government bodies have actually large financial assets, such as holding $1 trillion of US debt, ironically. So Japanese net debt is closer to 150% of GDP. And when looking at debt, it's important to also remember the assets of the government. So if the government nationalised, say, the water industry, its debt would go up, but also you have more assets, which in theory can get revenue for the government. Now, the Japanese debt is still pretty high at 150% of GDP, but it finances it mainly by selling to domestic savers, got an ageing population, quite high savings. And this is an important point, that if a country has its own currency and sells the majority of debt to domestic savers, you can say the country will never default, because in theory it can always create its own money, create its own currency, and then buy its own debt. Now, this is true to some extent, but if you do create too much money, then this will cause inflation, devalue the currency, and this will cause a partial default, because very high rates of inflation will reduce the real value of bonds. And this happened to some extent in the 1970s, when inflation was much higher than expected and bondholders lost out. Bond yields. For many years, Japan had very low bond yields despite this very high debt. But this year, we've actually seen a rise in long-term bond yields in many countries. This reflects a slight uptick in inflation, but also a growing concern about the long-term fiscal sustainability of these major economies. And of course, bond yields can bring governments down. September 2022, bond yields rose in response to the Truss mini budget. And when markets lose confidence in government policy, it can force a government to do a U-turn. It can even bring a government down. Now, sometimes fear of a bond market can be used to justify austerity, even if there's actually quite strong demand for buying debt, like in the early 2010s. Bill Clinton's political advisor said if there was reincarnation, I would like to come back as a bond market. You can intimidate everybody. But debt really is increasing at the moment wherever you look. And why is it increasing? Well, in recent decades, most advanced governments have seen a big rise in debt. The average debt for G7 has increased from 41% in 1978 to 127% in 2023. And of course, on current policy, debt is forecast to rise in most countries. Now, this reflects a big change in demographic factors. Populations are aging, birth rates are falling, and this means higher spending on healthcare and pensions. But with a shrinking working age population, tax revenues will not be keeping up with the demand on government spending. Now, a very few countries invested in a sovereign wealth fund, investment protected from day-to-day spending, but giving interest on investment to help meet spending. Norway, of course, and the other oil-rich states have built up trillions. They've also bought up quite a lot of London too. But most Western economies like the UK and US never created a pension fund. The UK used its North Sea oil revenues to cut taxes in the 1980s. So any future pensions will need to be paid out of future tax payers. Now, there are many other factors. For example, the UK has seen a rapid rise in sickness and disability benefits, a rise in social care spending, a desire to spend more on military spending. The problem is that as the current government is finding out, once the electorate have a certain spending or tax breaks, it's very hard politically to take it away. It's pretty easy to give a popular policy like, say, the pension triple lock, but after you've introduced it, you kind of end up being stuck with it. And if you can't increase taxes or cut spending, the easiest short-term political response is just to add it to the debt, add it to the increase in national debt and worry about it in the future. Now, can't we just print money to pay for things? Well, in 2009, central banks started to create money to buy government bonds as part of quantitative easing. Now, the main motive was not to finance the government debt. They did it because interest rates were close to zero and the economy was still depressed, something called a liquidity trap. They wanted to create money to try and stimulate economic activity. Funding the debt was kind of a side benefit, you could say. The problem is that in 2022, inflation and interest rates rose. So central banks started to reverse quantitative easing as they felt the monetary stimulus of QE should be taken away. Now, a modern monetarist theory of debt is that governments can spend without collecting taxes or borrowing. They just get the central bank to create money, and the only key constraint is not the level of borrowing, but inflation. In the MMT model, the central bank would concentrate on creating money, keep interest rates very low, and the government would control inflation through taxes. Now, I remain quite sceptical of this for quite a few reasons. Firstly, I wouldn't trust the government to control inflation through raising taxes. Virtually politically impossible for a start. Also, creating money to buy debt is fine when inflation and interest rates are very low, like the 2010s. But creating money to funnel into the real economy could very easily create inflationary pressure, especially when underlying inflation is already above target. Also, there are very few, if any, examples of successful MMT theory in practice. Possibly Japan and Singapore are floated, but there are much more examples of countries printing money where it has been a disaster. Germany, Zimbabwe, Venezuela could go on. Is the UK going to go bankrupt? Well, definitely not in the short term. The UK has had much higher levels of debt in the past. And it is true that with your own currency, you can always create money to buy bonds if necessary. However, that doesn't mean it can't become an increasing problem. The projections for debt are a concern because they're due to long-term factors, which may also coincide with very low economic growth. And what will happen is that we could end up spending a much higher share of national income on debt interest payments, which is of course good for bond holders, but with a huge opportunity cost for standard taxpayers. That's £120 billion what we could spend on healthcare, education, or cut tax. Also, it is quite possible that if growth remains stagnant, we do get to that dynamic where debt becomes an ever-increasing problem. For example, will the pension triple lock guarantee eventually bankrupt Britain? This video examines that question in more detail, so do check it out. And thanks for watching. Leave your comments. And if you've got a question, do put it in there. Maybe in a future video, I'll get around to answering it, especially if it's related to debt. Pretty interesting question, and only going to get more bigger topic in the coming years.